Good afternoon and welcome to the Think Realty webinar series. My name is Rodney and I am the Director of Sales for Think Realty. We're so glad that you joined us today. Today we have Tom Schmidt from mainstar Trust with us, and he's going to talk about self-directed IRAs and what you need to know. Before we get started with that, just a friendly reminder, we have two Think Realty events coming up. We have Atlanta on September 19th and 20th, and we have Baltimore on October 24th and 25th. Both of these are going to be a brand new version of Think Realty events. They're going to be hybrid. What does that mean? That means if you feel comfortable and you can attend in person, we would love to have you just go on to thinkrealty.com and purchase the in-person tickets. If you don't feel uncomfortable attending in person, perfectly fine. Go to the same web address at thinkrealty.com. You can purchase your virtual tickets, and you can go to the Think Realty app and see the schedule, the speakers, be able to watch and participate with questions with any session. So we're very excited for both of those events. So don't forget to get your tickets today. So with that, we will turn it over to Tom, and I am going to make him host. And Tom, it is all yours.
Okay, great. Well, good afternoon, everyone, and we appreciate you joining us, and we appreciate the partnership with Think Realty. I'm Tom Schmidt, as Rodney said, and we're going to talk to you about real estate IRAs and what you need to know today. So I'm going to cover a lot of material. The purpose of this session is really to educate you not only on IRAs, but how you can use an IRA to invest in real estate. So here's what I'm going to cover today. I'm going to give you a little bit about who we are, mainstar Trust, talk a little bit about, as an investor, what you can self-direct, drill down a little bit more into IRAs and other types of retirement accounts and their benefits, as well as retirement account tax strategies. If you're going to use a retirement account, what's the impact with real estate and whatnot. And then we'll get into real estate. What are the options if I'm going to use an IRA, whether it's direct partnering or indirect. There are some no-nos you need to be aware of if you are using an IRA. It's not a reason to not do it, because many investors use their IRA to invest in real estate. But you do need to be aware of the no-nos, and the consequences can be significant with the IRS if you do not follow the rules. So doing it the right way is really my message. And then I'm going to go through the common questions we get from investors like you who want to use real estate. So a little bit about mainstar. We were at one point called First Trust Company of Onega. You may know us with that name, but we rebranded about 4 years ago to mainstar Trust. Reason for that is because we are a national custodian. We have clients in all 50 states. We're headquartered in Overland Park, Kansas, which is part of the Kansas City metropolitan area. And the origin of our business is Onega, Kansas, which is where our operations center is, about 2 hours outside of the Kansas City area. We've been in business for over 40 years. We're very, very proud of our customer service. We're well known for that. You're welcome to check out our reviews on our website at mainstartrust.com. We're very transparent in that way. The other strength that we have is we have a very experienced, knowledgeable team. Our leadership team has worked with IRAs on average for over 20 years. So very, very experienced IRA team. And the reason this is relevant is, IRAs are a great mechanism to invest, and there's a lot of tax advantages. But there are nuances associated with them that can make them a little bit more complex. And so you do need to be able to work with a custodian that has a very experienced staff that can help you with your questions. Our focus primarily is on providing custody for non-exchange traded investments. We certainly can handle stocks and bonds and mutual funds, but typically the reason most investors come to us is they want to use their IRA or an individual 401k to invest in things like real estate. And so we handle the investments, and there's a wide variety of them that your brokerage firm, your typical brokerage firm, will not handle. And so the thing you should know with an IRA, you can hold many types of assets within an IRA. There's really just a few exceptions that are not allowable according to the IRS. Life insurance, collectibles, those are just a couple of gold, or not gold, but precious metals of a certain type, right? Are examples of things that the IRS frowns on. We are one of the largest custodians nationally. We custody about $8.5 billion in assets, and we're very, very competitive with our fees. Our fees are flat service-based fees. The thing you should be aware of there is, as you're looking at different custodians, some of our competitors charge fees based upon the size of your account. As a custodian, we're not allowed to give any type of investment advice to you. We're really providing a service for you. And as a result of that, we charge flat service-based fees. So if you have a $1 million account with us or a $10,000 account, we're going to charge the same fees based upon the same activities that are requested. So a little bit more on assets that we custody. Very common are REITs. These are products that an investor may want to invest in, real estate investment trusts, managed futures, hedge funds, private equity funds. There's a whole host of private placement products like private stock or investing in early stage businesses. Limited liability corporations, or LLCs. We'll talk about that more in this presentation. Real estate, of course, mortgage notes and other types of notes, limited partnerships, and then more traditional investments. So again, there's a wide variety, and that's really our focus primarily, is on the assets that are held outside of the stock market. So let's talk a little bit about your responsibilities as an investor in a self-directed IRA. You're responsible for doing the due diligence on the investment product and making sure that it's suitable for you based upon your age, your risk tolerance, and your objectives. So you are ultimately responsible for those investment decisions. Based upon this, we always recommend that you consult with your legal counsel, a tax advisor, and/or a financial advisor on the investment choice and the appropriateness of the investment based upon your individual circumstances. So that's always very prudent. Our role is as a custodian, and the IRS, with the advent of the IRA, the IRS dictated that a third party must take custody of the assets of an IRA because of all the tax benefits of the IRA. And so because of that, they turned those responsibilities over to custodians. And so really we're really an administrator. We do the administration, if you will, record keeping and tax reporting. We are regulated, and the other thing, as I mentioned earlier, we do not endorse any investment products, nor do we have any affiliation with any investment sponsors. So we do work with a lot of different investment sponsors that are raising capital and want to have their investment products on our platform, but there's never any affiliation between us and them. We do a review of the investments you decide to invest in, say real estate or a mortgage note. But we're not doing due diligence. Again, that's your responsibility. We're not a fiduciary. As I mentioned, no investment advice. Really what our role is we do a review of the investment to make sure that it is something that is appropriate for an IRA. Again, I mentioned earlier, certain types of investments that are not appropriate for an IRA. So I get the question frequently, hey, Tom, what can I self-direct? And a lot of times it's, hey, I'm currently employed. I have a 401k. Can I self-direct that? And the answer to that is probably not. You need to check with your plan administrator, which the plan administrator is a firm that your employer has hired to do the record keeping and keep track of the 401k. And every plan is a little bit different, but the vast majority of them do not allow you to self-direct the 401k until you've terminated employment or you've retired. And I'll get into that in more detail. But certainly ask the question. If you have the ability to self-direct a portion of your 401k, mainstar can help you in that particular circumstance. The other common question, can I self-direct an individual 401k? Absolutely, because you, as the small business owner with no employees, have the ability to determine, what the plan can invest in, and the underlying participants, that is. So absolutely on that. And of course, yes, you can on a self-directed IRA. That's really our primary purpose here today. So let's drill down on that a little bit more. I get the question frequently, hey, Tom, how do I get the money into an IRA? And there's two primary ways you can do it. You can do it through contributing to an IRA, and I'll talk about that more in a few minutes. The problem with contributing to an IRA is you're not able to contribute that much on an annual basis. So most of our self-directed investors actually are doing some type of rollover, and they're doing it in one of two ways. They're either doing a rollover from their defined contribution plan or defined benefit plan. Those are like 401ks, 403bs, 457s, that type of thing. They're either doing a rollover that way, or they have an existing IRA with another custodian, and they want to move either all or a part of that IRA to mainstar, say, to invest in real estate. The beauty of the IRA, unlike, say, a 401k is that the structure of the IRA, the way it was put together by the IRS at the time, is much, much more flexible. So you can have 2 or 3 IRAs. You can have one IRA for investing in the stock market. You can have another IRA for investing in real estate. You can have another IRA for another investment purpose. So you can consolidate them or split them. Those are all great benefits. As I mentioned, the way that the vast majority of assets are accumulated, though, is through a rollover from some kind of 401k. And as I mentioned earlier, the eligibility varies from plan to plan. So you would need to check with your employer or their administrator to understand the rules. Typically, if you have terminated employment from that employer, or if you've retired, almost always you can do some type of rollover in that particular situation. There are other circumstances, though. Sometimes if you're age 55, or with some plans, even if you're over age 50, you can take a portion of that 401k and roll it over. So we always recommend that you understand what the eligibility requirements are for your plan, even if you're still currently employed. So let's talk about types of self-directed accounts. There's a wide variety, as you'll see from this chart today, which is great. I'm going to drill down in more detail on the most common types. One that I'll highlight here that I'm not going to talk about later is the health savings account. I bring this up because most people don't understand that you can self-direct a health savings account. And this is important as many long-term investors are using health savings accounts for a tax deferral strategy. And they may be saving for 20 or 30 or 40 years and not taking out anything for medical expenses because they want to use it for long-term medical expenses, if you will. And because of that, more and more investors, and again, the health savings account is associated with a high deductible plan. And so more and more investors are using that health savings account to self-direct. So let's talk about the most common types of IRAs. On the left-hand side of your chart, there is the traditional and the Roth IRA. The traditional IRA is pre-tax. The Roth IRA is post-tax. The contribution maximums on an annual basis are the same in both cases. $6,000 a year and $1,000 catch-up, or $7,000 a year if you're over age 50. There are income limitations on both of these that determine, in the case of the traditional, how much you can deduct, as well as whether you can contribute at all. So that's something to talk with your tax advisor on. If you look at the traditional IRA, the investment grows on a tax-deferred basis. That's because it was pre-tax. You got the tax deduction. For the Roth, it grows on a tax-free basis, which is a great tool. And then the other thing to be aware of are distributions. So this is how you can take it out without penalty. In both cases, you have to be over age 59 and a half. In the case of the traditional IRA, when you do take it out after age 59 and a half, you need to keep in mind that it is taxed at ordinary income rates at that point. So from a tax planning standpoint, that's important. There is something that is called a required minimum distribution that's based upon life expectancy, and you have to begin taking those RMDs at age 72 for a traditional IRA. The Roth IRA, though, on the other hand, has other benefits. As long as you have contributed to the Roth IRA for 5 years and you're over age 59 and a half, so 5 years from that initial contribution, the earnings as well as the principal grow tax-free, which is awesome. And there is no required minimum distribution for a Roth IRA. So we'll talk about these in more detail, but depending on your circumstances, that'll determine what's best for you. From a small business standpoint, the most common are a SEP IRA and an individual 401k. The SEP IRA is pre-tax. It works very similar to a traditional IRA. For a SEP, you can contribute up to 25% of, I say you can't, actually your employer for a SEP has to make the contribution, but it can be up to 25% of the employee's compensation on an annual basis for a maximum of $57,000. So if you can do that, it's a great tool, but it's something that the employer has to do on your behalf. In some cases, it's the small business owner that's making this decision that we work with, and of course, they're able to control that for their employees as well as themselves. Like the traditional IRA, the SEP is tax deferred, but it's taxed at ordinary income rates. When you take it out after age 59 and a half, then it is subject to RMD. There is something called an individual 401k, and again, it's for a small business owner that has no employees other than perhaps a spouse that's working in the business. If you have part-time employees that have to be working less than 1,000 hours a year, you can set it up as a small business owner on a pre-tax basis or a post-tax basis, like some of the others we've talked about. The beauty of the individual 401k, though, is you can, again, it's subject to income limits in terms of how much you can contribute and whatnot, but you can contribute up to as much as $57,000, and if you're over age 50, an additional $6,000. So again, something to talk to your tax advisor about. But from an ability to contribute on an annual basis, subject to your income, it's a great way to contribute. And again, the investment growth just follows whether it's pre or post tax, and the same on distributions. So great options for you to consider. So let's drill down on why you might have a traditional versus a Roth IRA. So people that have a traditional IRA, and again, this is pre-tax, might decide to have a traditional IRA because once they retire, they believe they're going to be in a lower tax bracket. So I talked earlier about being taxed at ordinary income rates. You know, if you're going to take it out at age 72, you may be at one of the much lower tax rates. So that's a tax strategy there. Other reasons, for some people, they can't contribute to a Roth IRA, so that's why they would do a traditional, and that's again based upon the income limits and guidelines for a Roth. The other thing is I talked earlier about rollovers. Many 401ks are historically at least pre-tax. And so if you roll it over on a pre-tax basis, you have to roll it over into a pre-tax IRA, which is a traditional IRA. So a lot of people are in the circumstance that it comes over as a traditional. And again, the benefit of a traditional is a tax deduction. Why would you do a Roth IRA? Particularly if you have quite a few years until retirement, or if you're investing in something that you think is going to go up substantially. Again, as long as you've held it for 5 years, those earnings grow tax-free, not only during the life of that Roth IRA, but at the time you take it out as a distribution after age 59 and a half. So from a tax standpoint, if it works for you from that standpoint, it's a great tool. The other thing you should know with the Roth, you're able to pass the assets tax-free to your heirs. With traditional IRA, that's not the case. And then the other thing is, for some people, they'll look at a Roth and say, hey, I'd rather pay today's tax as opposed to paying the tax, at some point down the line, because I think my net worth or my assets are going to grow substantially within my IRA. So anyhow, a good way to think about both of these, and as always, consult your tax advisor. So there is something called a Roth conversion. A Roth conversion is the ability to take money in your traditional IRA and convert it to a Roth IRA. Again, the Roth IRA grows tax-free. There's no required minimum distribution. You're actually able to do a portion on an annual basis to minimize the tax impact, and I'll talk about that more. But in the year you do a conversion, there is a tax impact in that particular year. So why would you do a Roth IRA? For some people, if they know their income in a particular year is going to be lower than normal, they'll do a Roth IRA, or not a Roth IRA, a Roth conversion, I should say, to create the Roth IRA, with the thought that they'll pay the additional tax, but they're going to be at a lower tax rate than normal anyhow. If you do a Roth conversion, though, consider things about what's your higher marginal tax rate going to be, and consider, the impact on your deductions, your Social Security, and your Medicare, of course. And then, where's the tax going to come from? That's always a big thing to think about. Are you going to take the tax out of the IRA from the conversion, or are you going to pay for it out of pocket? So it's not like it's being withheld from your paycheck. Like on a normal basis, the tax here would be a substantial amount. So from a tax planning standpoint, this is very important. Other things, when you're considering, think about where tax rates are going to be now versus later. We've talked a little bit about that. For some people, from an estate planning standpoint, they want to pay the tax now, so the beneficiaries will receive the income tax-free for their lifetime. And there is something that I'm asked this occasionally called a re-characterization. Re-characterization was the ability to kind of reverse your Roth conversion to go from a Roth back to a traditional. That's no longer available for the principal amount of the Roth conversion. It's only available for the contributions that go into a Roth IRA. So much more limited than it once was. So if you hear of re-characterization, it's something to talk with your tax advisor about, but it doesn't apply to near as many people as it once did. Okay, let's talk about just general taxation if you're going to use your IRA to invest, say, in real estate. First of all, make sure you understand the tax impact and compare the impact in your IRA versus on a non-IRA or your taxable account. The first thing that I know I get the question a lot that people are confused about. So let's say, you purchase the real estate with your IRA, which is something that you have to do, and I'll talk about that more later. But after 10 years, after holding the investment property in your IRA, you decide to sell that piece of property. You work with your custodian to sell the property. The proceeds from the sale of that real estate have to go back into the IRA in cash. The purpose of doing this is it avoids taxation, right? So once the cash from the sale of the real estate goes back into your IRA, you can use it to invest in other real estate deals or whatever you decide. So it's no different, if you have a mutual fund, let's say in your IRA, and you decide to sell it, you want to buy another mutual fund. It works the same way, except for in this case, we're talking about real estate. And you're able to do it without paying any tax. With an IRA, the tax comes into play potentially at the time you do what's called a distribution. So unless it's an extenuating circumstance for most people, it's after age 59 and a half. The other thing to think about, is there a tax disadvantage if I use my IRA? Well, again, it depends on your circumstance. Talk to your tax advisor. But if you were not using an IRA and you sold that real estate, there is an impact on, well, I'm sorry, not on selling the real estate, but there's an impact on your tax deductions as well as your depreciation and mortgage interest. So you no longer have a tax deduction for depreciation, mortgage interest, rather with an IRA like you do if you're using your non-taxable account. The other thing is if you have a taxable gain or a taxable loss on the sale of real estate, you no longer have that with an IRA. So depending on your circumstance, that might be very good from a tax planning standpoint, or that may be something that may not be appropriate for you. So let's get more into real estate investing itself with your IRA. We talked generally about IRAs and the benefits there. If you think about real estate's a great asset class. For many investors that work with mainstar, they want to diversify outside of the stock market. So they're still going to hold, a certain percentage in the stock market, but they want to diversify into other asset classes. And so there's two primary categories, if you will, of real estate investing. There's direct real estate and indirect. Direct is, single family, multifamily, land, tax liens, mineral rights are all examples of direct real estate. That's where the IRA itself, with your custodian, takes direct title to the real estate of the IRA. Then there's indirect structures that you can use your IRA to invest in, things like LLCs, limited partnerships, syndications, and that type of thing. And then there's a third type, which is actually a type of indirect, but is very popular, which are notes, mortgage notes as an example. So we'll talk about that in more detail here in a few minutes. So I want to walk you through some examples of direct real estate investing as well as indirect investing. So the first is direct specifically, and we're going to use the same example across all four situations just to compare and contrast. So in the first one, we have Jane Doe, and Jane has decided that she wants to use her IRA to purchase an investment property. In this case, it's a duplex. So Jane works with mainstar to set up an IRA account with mainstar. She moves money from her existing IRA, or she does a rollover, and she moves $200,000 over to mainstar, maybe a little bit more for expenses and whatnot. So mainstar set up the account. Now there's $200,000 in the account, and then Jane authorizes mainstar to purchase that investment property, the duplex, with her IRA money. So once that happens, mainstar sends out the money on behalf of Jane's IRA. If you're looking at the title, the deed, if you will, is going to say mainstar trust custodian for the benefit of Jane Doe. Now that duplex hopefully is going to earn income from tenants, but of course it's going to incur expenses. It's very important to understand that all income and all expenses associated with that investment property must be directly associated with the IRA. And we'll talk about things like prohibited persons and prohibited transactions, some of the no-nos later. But what happens to do it the right way is the income, right, from the tenants flows back to the custodian, and mainstar will record that income in Jane's IRA. And then any expenses, rather, that need to be paid for the duplexes, Jane would reach out to mainstar, and mainstar would write a check or wire or what have you to pay the expenses associated with the IRA. So that's a very, very common model called the direct model. Now let's talk about partnering. Partnering has become very popular. So in this circumstance, Jane also wants to purchase the $200,000 duplex, but she doesn't have enough money in her IRA, or she's chosen not to use that much of her IRA. So there's a concept called partnering that only can occur at the time of the initial purchase of the real estate. So Jane is going to use $50,000 from her IRA after she sets up her account with mainstar. She's going to use $50,000 of her personal money. She has talked to her dad, John Smith, about using $50,000 of his. And she has a coworker, Tom Jones, that is also going to contribute $50,000 to purchasing the duplex. So here the great advantage is it allows investors to pool money, if you will, to be able to purchase an asset that they may not have been able to otherwise. So in this example, as it relates to the IRA, Jane is going to authorize mainstar to send $50,000 from her IRA to the closing for the investment property. Jane personally, for her personal $50,000, John Smith for his $50,000, Tom Jones for his $50,000, are all going to send that money, not through mainstar, but directly for closing. So very similar to what we talked about before, but a couple of differences. So if you're looking at the deed is going to say mainstar trust custodian again for the benefit of Jane Doe, but 25% because Jane owns 25% of the duplex with her IRA. Jane Doe personally owns 25%. John Smith owns 25%, and Tom Jones owns 25%. So that's how the deed would be titled. That duplex, of course, is going to earn income from tenants, and there are going to be expenses. But now you've got multiple parties involved, so it's a little bit more complicated. 25% of the income or rent received has to go back to the IRA. 25% of the expenses has to be paid by the IRA. So you can't have a situation where Jane's IRA owns 25% but is paying 10%. That's a problem from the IRS's standpoint. Or the IRA is paying 35%. So the relationship has to be directly proportionate to the ownership, if you will. And again, the 25% has to flow back to be recorded in the IRA of the income, that is, and then mainstar would pay 25% of the expenses, be sending checks or wires for those expenses. So let's talk about indirect real estate examples. The LLC model is a very popular model. It's a little bit different than the examples we talked about. In this example, Jane wants to use $200,000 again, and she wants to buy real estate ultimately. That's her end objective, but she's going to use an LLC. Different parties use LLCs for different things. Sometimes they believe it, as they work with their attorney, it's a good strategy from a asset protection standpoint. And so in this particular example, Jane's going to work with mainstar to set up the account, move the $200,000 to her mainstar account. But on a parallel path, Jane has decided to create an LLC. She's worked with an attorney to do this. And so the LLC is called ABC LLC. It's a single member LLC in my example. And she opens a bank account associated with the LLC. So Jane authorizes mainstar to send the $200,000 from her mainstar IRA to the LLC bank account. At that point, since Jane is the managing member of the single member LLC, she is going to take the $200,000 out of the LLC bank account and purchase the investment property, the same $200,000 duplex. So in this model, the deed owner is ABC LLC. As opposed to Jane's IRA. This same duplex is going to have income from the tenants, and it's going to have expenses that need to be paid. So in this particular example, the bank account is receiving the income back from the tenants and then the bank account for the LLC is actually paying the expenses. Now, if there are any income or dividends associated with the LLC, that has to be paid from the LLC bank account or from the LLC rather, back to the mainstar IRA to be reported in the IRA. At the time that those proceeds are sold or the LLC is dissolved, those assets, again, to avoid taxation, have to flow from the LLC back to the custodian, be in cash in the custodian. And then at that time, if Jane decides that she is over 59 and a half and is ready to do a distribution, she would instruct mainstar to take it out of her IRA. So this model, for some investors, they like it because it provides more flexibility. It's typically a model that is used by a more experienced investor that is working with a CPA, providing tax counsel. You need to be very careful in this model because every CPA is not necessarily familiar with the nuances of this. Because you're not only working with, doing the record keeping of the LLC, because all the income and expenses need to be reported in the books and records of the LLC, but you have to make sure that the transactions that are occurring are not prohibited transactions or prohibited persons, and we'll talk about that more from an IRA standpoint. You never want to get into a situation where you're risking the tax status of the IRA by doing something the IRS would not approve of. And the thing to keep in mind is if you're ever audited, the IRS is likely to do a look through. So they're not only going to look at your IRA, but they're going to look into the underlying books and records of the LLC to make sure that the transactions that are occurring are appropriate for the IRA and beyond. So again, it's a good model, but it's for the experienced investor that has a strong CPA. Another example of indirect real estate is a mortgage note, as I mentioned earlier. Here we go again with Jane, and Jane wants to invest $200,000, but in this case, she's not going to really buy a rental property, rather. Instead, she has talked to Tom Jones, and she is essentially using her IRA to create this note to loan the money to Tom Jones. And so the difference is once the $200,000 is in the mainstar IRA, Jane creates a mortgage note and agrees upon the terms with Tom, the interest rate, the payment schedule, etc. So she and Tom agree upon that. And then Jane instructs mainstar to send the funding to a service agent who's going to service the note. So at that point, the $200,000 is with the service agent, and Tom Jones is then able to go ahead and use that money to go out and purchase, say, the duplex in this particular model. The difference is, you'll notice that, first of all, the title is Mainstar Trust Custodian for the benefit of Jane Doe, but again, it's a mortgage note that's the asset within the IRA as opposed to an LLC or the real estate. The only way that Jane takes direct title to the real estate is if the mortgage note were to default, or the borrower, if you will, were to default. So it's a great strategy for somebody who wants to participate in the real estate asset class, but on a totally passive basis, and not have to worry about things associated directly with the real estate. In this model, of course, the note is going to have interest associated with it and principal payments that the borrower is going to make to Jane's IRA. So the service agent is going to forward the interest and principal, if you will, back to Jane's IRA. mainstar will record that accordingly within the IRA. Again, it's critical from a IRS standpoint that interest and principal come back to the IRA and not to Jane personally. So those are the most common examples, just to give you an idea. We thought an illustration might be helpful in understanding different strategies that you might employ. Another situation that comes up is people ask, can I take a loan from my IRA? And in most circumstances, the answer to that is no. There is something called a non-recourse loan, and this is when your IRA property is debt financed to purchase a property, and you're able to do this with a non-recourse loan in addition to the IRA funds. So essentially, you would work with a financial institution. Typically, the interest rates are a little bit higher than a normal interest rate, but there are institutions out there. And as they look at you to approve your loan, they're not going to do it in a way you might expect. They're going to totally do it based upon the property that you're investing in. And the reason for that is the only collateral in this particular model is the property itself. So they're not going to look at your personal assets outside of the IRA, et cetera, because they're not able to collateralize those assets. So again, it can be a strategy for people that are, another way to be able to purchase a property that perhaps they couldn't otherwise. The one thing to be aware of is that the portion of the investment earnings that were achieved through debt may be subject to something called UBIT, which I'll talk about in just a moment. It's likely to be subject to UBIT. That's not necessarily a bad thing, but this is something to talk with your tax advisor about, because there can be a tax that you would be paying to the IRS. But in the circumstance that this may be the only way you're able to purchase the property, and it's part of the way you look at the deal, it still can be a very effective strategy for you. But again, consult your tax advisor. So what is UBIT? It's unrelated business income tax. It's typically, and it comes into play a lot with LLCs or limited partnerships, but it's income from a business that is not directly attributable to the primary purpose of the business in a retirement account. So I know that's kind of a broad definition, so let me give you an example. If you use your IRA to invest in an oil drilling partnership, and the drilling equipment owned by the partnership is leased to another company to use, that rental income in that example would be an example of UBIT potentially. So UBIT is a little bit complicated. It's something to talk to the investment company perhaps you're investing in. If it's not direct real estate, it's definitely something to talk to your CPA about. As a custodian, we will file, there's a specific tax form if you have over $1,000 of UBIT within your IRA on your behalf. We will file that on your behalf to assist you as well. So again, it's not necessarily a negative, but it's something to be aware of within your IRA. So I talked earlier, referenced the no-nos. Let's drill down on those, because these can be pretty painful if you ever experience these. So let's talk about prohibited transaction principles. Prohibited transactions, if they occur, can risk the tax-deferred status of your IRA, and you could be subject to IRS fines. So, if you have a $500,000 IRA and that immediately becomes taxable, as an example, that would be catastrophic. So the principles are that if you're using an IRA to invest in real estate, any deal that you do has to be passive. It has to be an arm's length transaction, much like you're dealing with a stranger, no self-dealing. So the exception to that is the example I gave earlier. If you're purchasing a piece of real estate for the first time, you can partner with somebody at the time of the initial purchase. So that's an exception. But like self-dealing, what's self-dealing? So if I have a property in my IRA that I worked with a custodian. I purchased the investment property in my IRA, and I decide to sell it and try to take it from my IRA and own it directly. That's not allowable. That would be considered self-dealing because the real estate was purchased in a tax deferred instrument potentially if it was a traditional IRA. So that's an example of the type of thing you cannot do without taking a distribution, if you will, selling the property back to cash and then taking a distribution out of the IRA would be the proper way to do it if you were eligible for a distribution. And you cannot receive any personal benefit from the property. So those are the guiding principles. We'll cover some examples a little bit later in this presentation that will help you. So I referenced disqualified persons. So this is the other guideline from the IRS. So what is a disqualified person, or who's a disqualified person? It's your parents, your grandparents, your children, grandchildren, your spouse, basically your lineal descendants, ascending and descending, right? And their spouses. So it seems pretty limiting, but let's go through some examples because it may not be quite as limiting as you're thinking about, but you would be determined to be a disqualified person in these examples. Neither the IRA nor any other disqualified person of that IRA may live in or use the property. So you purchase a rental property with your IRA, you can't live in it, nor can your children or your parents if you're using an IRA. Disqualified persons cannot work on the property for free or for pay. So if you're handy, from a maintenance standpoint, or maybe your son is, or your daughter, they can't do the work for you because they're a disqualified person. They can't do it for free or for pay. Again, because it's the property that you purchased with your IRA. Your IRA cannot purchase a property from you or any disqualified person, nor can your IRA sell a property to a disqualified person. That's similar to the example that I gave earlier. If you're doing it to yourself, that would be a disqualified person example. Let me give you another example. Because I get this question frequently. Let's say I own the $200,000 duplex already, but I want to put it into my IRA. And so I decide to, and the value of the investment property, let's say the duplex is $200,000. So I sell it from myself individually, but I say I sell it for say $50,000 because the property has been devalued for whatever reason. So now I have a capital loss on my tax return. It goes into my IRA, but then it's valued at $200,000 because that's the real value. Of course, that's not right. That's an example of self-dealing, right? So where there has to be an arm's distance between you and the buyer or seller. So whether that's you or another disqualified person, that's not allowed. You can never put an investment property that you already own into your IRA. Neither you nor a disqualified person can guarantee a loan for an IRA property, and disqualified persons are never allowed to be paid by the IRA for any reason. So I've covered all the things you can't do. So does that mean you can't use an IRA? Absolutely not. You can to purchase real estate. Good news is, you can do a deal with an aunt, an uncle, a cousin, a niece, a nephew, friends, and non-family business acquaintances. None of those parties are disqualified from a disqualified person standpoint. So still lots of options out there for you. So let's get into the most common questions we get. Can I personally use the property that was purchased with my IRA funds? I think we talked about this, but no, not for you, your spouse, or any lineal ascendants or descendants. You cannot use it. A rental property cannot be used for personal use. by any disqualified person, again, in that chain that we talked about. Or you can't rent it out to a family member, or it can't be used as a vacation home or as a second home, as we talked earlier. So you have to be mindful of those rules if it's a disqualified individual. Can the rental income from the property in my IRA flow back to me personally? No, the income must flow back to the IRA. If you need it to come back to you personally, it goes back to the IRA. If you're eligible, you would do a distribution, say if you're over 59 and a half, and that would be the way to get the income. You might have a tax impact at the time of the distribution. If it's a traditional IRA, you certainly would. If it's a Roth IRA, and it's over 5 years, it would not. But either way, it cannot flow to you personally. That would be a prohibited transaction. It has to flow back to the IRA. Do expenses like utilities, repairs, improvements, taxes, and mortgage payments need to be paid from the IRA account? Yes, the IRA account holder must pay all costs of the property out of the IRA. So you can't pay some of the expenses out of pocket, and some of them from your IRA. They all have to be paid by the IRA and paid by the custodian. So basically, you're initiated instruction to the custodian to make that payment for you. The other thing to keep in mind, there must be enough cash in the IRA. So you need to keep some liquidity there for expenses, for not only mortgage payments, but property taxes, insurance, HOA, dues, etc. Since the IRA has to pay it, you need to have some liquid cash held within the IRA. And again, if the expenses are paid with personal funds, it would be considered likely to be a prohibited transaction by the IRS. Can I transfer real estate I already own into my IRA? We've talked about this. No, you cannot. Unfortunately, you cannot. The IRS considers this to be a prohibited transaction because, as I mentioned earlier, it's not an arm's length fair market sale. Can I be the property manager of my investment property? We do get this one a lot. Same thing. No, you cannot. You have to pay a third party, and it also can't be a family member that's a disqualified person. An independent person must be hired to do any maintenance or repair work needed. That's called sweat equity. You can't have any sweat equity, if you will. So it has to be an independent third party that does any work. Same thing for rehabbing, like a fix and flip, that kind of thing. It must be performed by a non-disqualified person. And again, the IRA must be used to pay for those services out of its own cash. Can I buy a house with IRA funds but use non-IRA funds to help pay for repairs or other expenses? I think we covered this. Again, no. It's considered a prohibited transaction and would violate IRS code or IRC code 4975. Can I sell the IRA property to myself? We talked about this. According to the IRS, absolutely not. It would be considered selling it to a disqualified person. So with all that said, does that mean that real estate's not a good way to use your IRA? Absolutely not. Again, the IRA has enormous flexibility. If you're wanting to diversify from the stock market, using your IRA is a great strategy depending on your own circumstances. So that's why we always want you to talk to a financial professional. But there's a lot of effective ways to use your IRA to invest in real estate. So please don't walk away from this thinking that there's just no way I can do it. You just have to follow the guidelines, of course, like anything from the IRS, to make sure you do it in an appropriate way. And as your custodian, we're here to assist you in the process. So how do you get started? The first thing that we would do is do what's called an asset review, whether it's direct real estate or indirect, LLC, mortgage note. We would review the asset, see if we had any comments on it, ultimately approve it. Once we determine it's administratively feasible. And from there, you would open your new account. with mainstar, we would work with you to either do your contribution or do a rollover from your current custodian or from your 401k plan if you're eligible. So at that point, step 3, your IRA is funded, and then you would direct us to make that investment on your behalf, whether you're purchasing a direct piece of real estate or what have you. You should be aware that there is a 7-day right of rescission. It basically means that you have 7 days after your IRA account is open to decide not to do so. So any cash in the IRA cannot be invested during that first 7 days. But again, the clock starts, if you will, from the day the account is opened. After that, 7-day doesn't apply again. And then the other thing to keep in mind is if you're trying to close on a deal quickly, it's up to you to whether you tell us to fund the deal with a check or a wire. Wire is typically most expedient if you have timing issues. And most importantly, as I mentioned, IRAs, there's a lot of benefits, but there's some complexity associated with it. We don't expect you to be an IRA expert. That's our job. So along the way, you would work with us as well as your tax and other financial professionals to assist you along the way. So don't feel alone by any means. That's why we're here. So let me cover our fees. Our fees are very competitive in the marketplace. I'm going to cover the example of a note, a real estate holding in an LLC. We charge $110 a year for your IRA annual account fee. That's an annual fee. We charge what's called an asset fee based upon the type of asset. So in the case of a note, it's $48. In the case of a real estate holding, $150, and an LLC, $36. So, your annual cost, ongoing annual cost is anywhere from roughly $150 to $250, $260, I guess it is, depending on the type of asset you're investing in. There is a one-time fee of $25 to open the account, and then there's a transaction fee that varies based upon the type of asset. The transaction fees occur at the time that you're buying or selling the asset from the IRA. The other fee that I don't have here, but if mainstar is making, let's say, an expense payment on your behalf out of your IRA on a piece of real estate, that's $10 per payment, if you will. For a complete list of our fees, they're on our website at mainstartrust.com under forms and fee disclosures. So feel free to check it out, but you'll see that the fees are very competitive. If you're looking at the LLC, it seems cheaper. The thing to keep in mind is, you're going to have the cost of putting together the LLC. You're going to have your annual registration costs for the LLC with your particular state. And then you're going to have costs you're going to incur from working with your CPA, et cetera. So again, cost shouldn't be the only objective. LLC is a great model, but it's most appropriate for the very, very experienced investor with good tax advice. The other thing here, so I talked about the IRA example, which is $110 a year. If it's an individual 401k, it's $150 per participant, and then $150 for the plan. A health savings account is $150 a year, as opposed to the $110. I would recommend that you go to our website. We have an ebook that we put together that will cover the different types of IRAs and the benefits in a lot more detail than I have today. So, check that out. It's a great resource for you, and we strongly recommend that you download it. So we appreciate you watching this today, and we're always here to help. So please reach out to us at any time. Whether you reach out to me or other members of our business development team, send us an email, set up a consultation. Be happy to talk about what makes most sense for you, as well as answer any questions that you might have. So again, we appreciate Think Realty for coordinating this recording today, and please reach out to us at any time we can be of assistance. Thank you.